Let's get some reaction from our top spot. And you didn't go over. The price is right. You did 162. Jason, I'm sorry. This is painful to miss. You were at 160, but you don't win. Kathy, good report?
Yeah, it's a good report. I mean, even with the downward revisions to previous months, it's still a good report. Labor market's maturing. These are the type of numbers you would expect. And average hourly earnings were up 0.3. That's actually better than expected. Looks like the unemployment rate went up to 3.7, but it's because the participation rate went up. So all in all, it looks like a pretty solid report.
Wait a minute. Do I have the wrong Jason? We've got two Jasons. Where were you?
160. But
That's you then.
I quoted Don Risk.
This is Furman.
Furman, you're way he didn't even...
way high at 180.
But you didn't correct me. You were like, I was really... that was me.
Didn't want to interrupt.
Let's see. Rick, why were you so high? And is you disappointed? Or how were the revisions?
Well, I think we'll get revisions up next month, so we'll come back and revisit my guess. Now, you know what? I think it's a very average report. I know everybody's thinking late cycle, this is so wonderful. You know, it's not far away from the averages. I think when eventually we get these trade issues resolved or the supply chains move, maybe the latter will turn out to be better historically when we look at it from the future. I think we're going to regain some horsepower and jobs. To me, there's three things in this report that are big and one I don't like at all, and that is average hour work week. That's really quite disappointing. That represents a lot of lost jobs. With respect to wages, you know, not too bad on wages. We recouped a little bit, up at 3.3 month over month. And, of course, the best news of all is the fact that we're including more people that we forgot to count in the labor force on the participation rate. But, you know, to me, it's just average, you know, C minus report, because I am more optimistic. I don't think jobs have run its course. I think, you know, one of the Jasons probably understands that. You know, there was 8 years there where I think we were on hold with regard to the economy. I don't even think you include that in the longevity of this expansion.
Rick, we've got a contingent here that's really worried about. They're not optimistic at all because of these tariffs. They think we're going to see some serious job growth that could threaten the re-election of Trump. Do you see that?
No, I don't think we're particularly late. We've talked about that. I don't think we're particularly late cycle. Because
what about the latest round of tariffs?
I agree.
You don't think those are going to?
They will absolutely impact. They're absolutely impacting manufacturing. I think you saw that in this report. It's probably impacted the willingness of companies to spend on CapEx this year. I think that's true. By the same token, it can change. It can change quickly. The U.S. The structure of the GDP report is such that it's difficult, without the participation of the consumer, to get a recession.
So many people to talk.
You can get a slowdown, but it's hard to get a recession.
Jason Furman, do you think that this is going to be a big problem in terms of the economy and also jobs? The latest round, the $300 billion.
I think the latest round is going to be a big problem for consumers. It's going to hit apparel. It's going to hit mobile phones, it's going to hit toys, it's going to hit a lot of things that people buy.
What about jobs, though?
And so where I think you'll see it in the real wage numbers more than you see it in the jobs numbers. This stage of our economy, you know, our participation rate rose this month. U6 fell to 7%. That's a cycle low. So our biggest issue isn't the number of jobs, it's how much they're being paid. And the tariffs are not going to help with that. They're going to hurt.
Douglas Holtz-Eakin.
Yeah, I'm going to agree with Rick and with Jason in that I agree with Rick that the bad number here is the work week. That's troubling development. I don't like that a bit. But there are really strong numbers here in participation and wages. That's how we should grade the labor market, not on the number of jobs. The demography is going to dictate that's going to slow. But this labor market's performing very, very well. And I'm concerned about the latest round of tariffs. It hits the one part of the economy, the household sector, that's been carrying it. And that's not what we need at the moment.
Steve, you were talking. I mean, referencing your worries. Do you want to?
Yeah, I'm a little more worried about this report than maybe the average bear here. I don't like the revisions to the prior month. I mean, look, let's set up the framework here. The framework is we expect job growth to slow, and the 3-month average now is off by 100,000 compared to where we were in January. 3-month average now, 140,000. Slowing maybe a bit more than I would have hoped for. Manufacturing and construction, manufacturing not too bad this month, but as Lalonde said, the overall average for the year is down, and it could take another hit. Retail is just a sea of negatives, one after another, one negative. And then something I like to look at, which is temporary help, which can be a sign of future hiring. That's down now. It's either negative or just up a little bit over the past 3 months. So I think you do have a cooling here. I don't know how much of it is related to trade and tariffs. The service sector seems to be doing okay at 133,000. Plus, you're getting a big boost from the government here. You've done 14,000 over the last 2 months. So that's 30,000 jobs have come from an increase in government. I haven't had a chance to look at that state or local. But we want to watch this carefully. The job market has been the thing that has been, you could point to say, you know what, the economy is not slowing that much. And then we had a guest in the last hour who said that if you can no longer express your concern about the future through a decline in CapEx because you brought it down as much as you can, you might then, as a corporate executive, express that concern through less hiring. And so that's where my big worry is.
That's interesting.
And that was a guest we had here, who brought that up. Now, maybe there's further CapEx cuts to come, or maybe the hiring reduces because of that. There's a lot to be said for as much certainty as you can provide to business.
Although it's funny, at a time where we're cutting rates, worried about what's happening, the worst we can come up is they may not hire as much. Not that they're going to be firing necessarily.
No, that's right. That's right. But then you would have a rise in the unemployment rate as a result. I think Joe was right last hour when he said, you can't really raise it that much because there's a very long way to go till the unemployment rate gets worrisome. But you want to watch the softening. It's hard. It's a hard thing to calibrate.
But then it immediately is said that there's nobody around left to hire. You just wonder when. That's the one when Zandy comes on. He usually says, what do you expect? We're at 160. There's not enough people around.
And we're not going to know. We're not going to know
whether
if
it's slowing or whether there's
hiring or if there's.
That is true.
The wages will give you that indication.
That's been a weird thing, though, Jason. Is you have not had this classic supply-demand relationship.
I would think, though, that you would think that price would be the arbiter of where supply and demand.
If that were the case, though, you would have had much stronger wage growth.
That would suggest that there's more slack in the labor market than you might think. That the labor force participation, there are more people that can come into the labor market as a result. Or there's another issue, whether it's immigration or other things that are changing the supply demand.
My theory on this, by the way, for what it's worth, is I think that if you're going down the experience and skill set of people you're bringing into the workforce as the labor market gets tighter, they do not command a higher wage.
Precisely.
So I think that's a reason.
Kathy,
I just wanted to add one thing that, I think that we could have 130,000 or so jobs and actually keep the unemployment rate steady. So the threshold, we weren't going to maintain 190,000 per month jobs. So as we have less workers and the whole overall economy matures, you're just going to have less job growth. So I don't necessarily see this report as worrisome, but I agree with Steve. We don't know what the tariffs are going to lead to. And if you see a further pullback on CapEx, could hiring be far behind? That would be a concern.
Hey, can Rick give us a quick rundown on what's happening in the interest rate markets out there? Rick, I don't see much change at all in the futures market and the outlook for the Fed from this report.
No. As a matter of fact, whether you're looking at the dollar index, 2s through 30s, not much change. And even all the other peripheral markets, although one thing's worth mentioning, Fed fund futures in the December month, which is the catch-all of all the log jams in front of it, is up about 3 ticks today. It was up yesterday after reversal on Fed Day. So the market is bringing back expectations. Eurodollar futures are mixed bag in the back months.
But that's post-tariff. That's post-tariff treat, not post-jobs, right,
well,
Rick?
it was well underway in earnest before the tariff tweet, and it did accelerate after the tariff tweet.
Jason, you're too quiet. The other Jason, Furman. Give us some. We need wisdom from you.
Look, we're seeing the slowing pace of job growth. It was interrupted last year by the fiscal stimulus, but now we're back on, the same track and trend line we were on before that fiscal stimulus. I'm not worried about that. 3.2% over the year on wage growth is pretty good, but it was better 6 months ago. And where is that? What's that a sign of? Maybe it's a sign that there's still more slack. I'm worried it's a sign that we don't have enough productivity growth to generate the type of wage growth we'd want. And to get productivity growth, you need some real reforms, and I'm not sure the ones we have are going to do it.
But Holtz-Eakin, will the economy be a positive story by the time the election rolls around, or will there be signs of a crack in the economy by the time November of 2020? Is it a tailwind, or will it be neutral or a headwind?
In the absence of a policy error, it's going to be a tailwind. It's going to benefit the president. If you look at it right now, if we held the election, the Democrats are not talking about the economy because they have nothing to say. I mean, it's doing really well. And so the question is, would that change between now and November 2020? I think only a big policy error would do it. The Fed and the president really have to play this right.
Okay, I need to save time because I need to thank everyone. Thanks. Let me do this. Thanks to our jobs panel, Jason Furman, Douglas Holtz-Eakin, Kathy, thank you. Rick, thank you. Steve, thank you. Jason, the other Jason,
Trennert.
Oh, I know your name, but I'm trying to think of a better
and
way.
Thank you, Joe.
And did they not
Joe.
put Steve? Oh, you're thanking me.
I'm thanking you.
You're welcome.
Nobody ever thanks you.
I have to do that.
Thank you,
anyway.
Joe.